Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about KWAH INT'L interim report. KWA International Holdings Limited offers a diverse range of businesses and services, including property development, residential developments, office towers, hotels, serviced apartments, retail premises, property management services for plus residential buildings, plus commercial facilities, plus office towers, plus real estate complexes, financial services, management services, decoration services. The KWA International Holdings Limited, KWAH stock price has experienced a decline in the past year, contrary to expectations of a significant increase. Despite reporting an increase in sales for 2024, net income decreased, resulting in a drop in basic earnings per share from continuing operations. The company's 2025 interim results showed a modest profit and dividend declaration, but these announcements did not contribute to a substantial stock price increase. In fact, the stock closed at $8.15 on September 19, 2025, which is 13.65% below its 52-week high, indicating a decline in performance over the last year. The primary drivers of revenue growth for a company are multifaceted. Attributable contracted sales and unrecognized attributable contracted sales are significant contributors, with $0.4 billion and approximately $6 billion respectively. Leasing performance is also a key driver, with high occupancy rates in various properties such as Shanghai KWA Center and Edge. The Hong Kong property market's 25% increase in first-hand residential transactions and the mainland property market's government intervention and policy support have also contributed to revenue growth. On the other hand, the primary drivers of revenue decline are largely due to external factors. Lower margins in projects due to downward price pressure, rental income decreased by 6.5%, and a significant decline in Hong Kong segment revenue by 33% are major contributors. Additionally, cost of sales has increased by 29.3%. These factors have led to a decline in revenue, highlighting the need for the company to adapt to changing market conditions and mitigate these effects. Net income and profit margins. A decline in performance. The financial performance of a company has experienced a significant decline between 2024 and 2025. Net income decreased by $65,407, representing a staggering 37% drop. This downturn is also reflected in the profit margins. Gross profit margin plummeted from 56.6% to 34.8%, while operating profit margin dropped from 34.2% to 15.3%. The net income for the first 6 months of 2025 was $623 million, which is lower than the full-year net income of 2024. The reasons behind this decline are not explicitly stated in the provided summary. However, it is clear that the company's financial performance has taken a hit, with all key metrics showing a significant decrease. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, the company has seen a notable decrease of $126 million, minus 7.8%, from $14,563 million to $13,437 million. This reduction is also reflected in the long-term bank loans, which have decreased. As a result, the company's financial burden has been alleviated. Furthermore, interest expenses have also seen a substantial decrease, dropping from $452,346 to $309,761. This decline can be attributed to a lower average interest rate of 3.2%, resulting in a reduction of 1.1%. Overall, these changes indicate that the company has made significant progress in managing its debt and interest expenses. There were no significant transactions involving the acquisition of new businesses or assets by the company. Additionally, the company did not sell off any major divisions or subsidiaries through divestitures. This suggests a stable and focused business strategy with minimal changes to its core operations. The company has a history of paying dividends to its shareholders. In recent times, it declared an interim dividend of 2 cents per share, resulting in a total payout of $63,055,000. This demonstrates the company's commitment to rewarding its investors through regular dividend payments. Concerns about inventory buildup and supply chain disruption. The financial summary highlights a pressing concern regarding the accumulation of excess inventory in the company's supply chain. This issue has significant implications for the organization, as it can lead to wasted resources, reduced efficiency, and increased costs. The buildup of inventory may be attributed to various factors, including overproduction, inefficient demand forecasting, or poor logistics management. To mitigate these risks, the company must reassess its production and distribution strategies to ensure a more streamlined and responsive supply chain. This may involve implementing just-in-time manufacturing, improving demand forecasting techniques, or investing in advanced logistics technologies. By addressing inventory buildup concerns, the organization can optimize its operations, reduce waste, and improve overall profitability. That concludes the financial summary for KWAH INT'L. Feel free to comment below, and I will be happy to answer them when possible.